For years, one belief sat at the center of the American financial system. House prices did not fall across the entire country at the same time. Individual homeowners could fail, particular cities could suffer. But the national housing market was considered too large, too stable, and too important to collapse. Banks built increasingly complicated investments on top of this assumption. Rating agencies described many of them as extremely safe. Pension funds, insurance companies, and investors around the world bought them. Almost everyone trusted the system. But a small group of outsiders began looking inside the investments, one mortgage at a time. What they discovered was disturbing. Millions of home loans had been made to people who could not realistically afford them. Many borrowers were attracted by low introductory payments that would rise sharply later. Lenders earned fees for creating loans, Wall Street earned fees for packaging them, and rating agencies earned fees for approving the resulting bonds. Almost everyone was rewarded while the machine continued operating. The future losses belonged to someone else. Michael Lewis's The Big Short tells the story of the few investors who recognized that the American housing boom had become a financial trap. Michael Burry, a former doctor with an unusual talent for studying ignored details, discovered the weakness by reading mortgage documents that almost no one else wanted to read. Steve Eisman, an aggressive and deeply skeptical Wall Street investor, came to believe that much of the subprime mortgage industry was built on deception. Charlie Ledley and Jamie May, two inexperienced investors working from a small office, realized that the financial markets were underestimating the possibility of a complete disaster. They saw the same crisis from different directions. Then they attempted something almost no one believed was sensible. They bet against the American housing market. Blink 1, the housing boom became a machine for creating loans. The crisis began with ordinary mortgages. Traditionally, a bank carefully examined a borrower's income, savings, and ability to repay. Because the bank often kept the loan, it suffered directly if the borrower stopped making payments. That created a strong reason to lend carefully. But the system gradually changed. Mortgage companies began selling loans to Wall Street shortly after creating them. Investment banks collected thousands of mortgages, placed them into bonds, and sold those bonds to investors. The original lender no longer needed to wait 30 years to discover whether the borrower would repay. It could collect a fee, sell the loan, and create another one. This changed the incentives. The number of mortgages became more important than their quality. As demand for mortgage bonds increased, lenders needed more loans to feed the system. They began accepting borrowers with weaker credit histories, unstable incomes, and little ability to make large payments. These were known as subprime borrowers. Some loans required little documentation. In extreme cases, borrowers could state their income without proving it. Other mortgages began with a low introductory interest rate, making the first payments appear affordable. But the low rate was temporary. After 2 or 3 years, the interest rate could reset at a much higher level. The borrower's monthly payment might suddenly become impossible to manage. This structure did not appear dangerous while house prices were rising. A struggling homeowner could refinance, sell the property, or borrow against the increased value of the home. Rising prices concealed the weakness of the loans. The entire system therefore became dependent on one condition. Home prices had to keep rising. As long as they did, borrowers could escape bad loans and investors could believe that mortgage bonds were safe. But if prices stopped rising, refinancing would become difficult. Defaults would increase, mortgage bonds would lose value, and the institutions holding them could face enormous losses. The machine appeared powerful because it was growing. In reality, growth was the only thing preventing it from collapsing. Blink 2. Michael Burry found the weakness by reading what others ignored. Michael Burry did not look like a traditional Wall Street investor. He had trained as a doctor before leaving medicine to manage money. He preferred working alone, communicated more comfortably through writing, and was willing to study financial documents that most investors considered painfully dull. His investment firm, Scion Capital, originally focused on stocks that appeared undervalued. Burry built his reputation by looking where other people were not looking. Then he became interested in the mortgage market. He began reading the details behind subprime mortgage bonds. Inside the long and complicated documents, he found thousands of weak loans. Many borrowers had poor credit. Some had borrowed almost the entire value of their homes. Others faced sharp increases in their monthly payments after introductory rates expired. Burry noticed that many of these resets were scheduled to occur around the same period. If enough borrowers began missing payments, the lowest portions of mortgage bonds would suffer first. But if the losses became large enough, even supposedly safer sections could be damaged. The opportunity appeared obvious to Burry. He wanted to bet against the bonds, but shorting mortgage bonds was not as simple as shorting an ordinary stock. Burry needed Wall Street banks to create a financial contract for him. The solution was a credit default swap. In simplified terms, Burry would make regular payments to a bank, similar to paying an insurance premium. In exchange, the bank would owe him money if a particular mortgage bond suffered serious losses. The banks were happy to accept the deal. They believed nationwide housing losses were nearly impossible. From their perspective, Burry was offering free money through years of premium payments. Burry saw the contract differently. His potential loss was limited to the premiums. His potential gain could be enormous if the bonds failed. He began purchasing credit default swaps against carefully selected mortgage bonds, but identifying the crisis early created a painful problem. Burry could see how the trade would eventually work, but he could not know exactly when the market would admit that he was right. Blink 3. Wall Street transformed risky mortgages into investments that looked safe. A mortgage bond contained thousands of home loans. The payments made by homeowners flowed into the bond and were distributed to investors. But not every investor accepted the same level of risk. Wall Street divided the bond into layers, known as tranches. The lowest layer absorbed the first losses when homeowners stopped paying. Because this layer was riskier, it offered a higher return. The upper layers received protection from the lower ones. They could lose money only after the weaker tranches had already been destroyed. This structure allowed rating agencies to give the highest layers AAA ratings, placing them in the same broad rating category as extremely safe investments. The logic appeared reasonable if mortgage defaults remained limited and unconnected. One borrower in Texas might lose a job. Another in California might face a medical emergency, but the failures were expected to occur separately. The models did not properly account for what would happen if borrowers across the country depended on the same thing, constantly rising home prices and easy refinancing. Wall Street then made the system even more complicated. The lower-rated pieces of different mortgage bonds were collected and placed inside a new investment called a collateralized debt obligation, or CDO. The CDO was divided into new layers. Once again, rating agencies gave high ratings to the upper portions. Risky pieces of mortgage bonds had been reorganized into new securities, much of which appeared safe on paper. But rearranging risk did not eliminate it. A collection of weak loans remained weak, even when the loans were divided, renamed, and placed inside a complicated structure. The complexity made the danger harder to see. Investors often relied on ratings instead of examining the underlying mortgages. Rating agencies were paid by the banks whose products they evaluated, while banks needed favorable ratings to sell the securities. Everyone involved had a reason to keep the system moving. The investments looked scientific because they used models, ratings, and complex language. But underneath them were homeowners whose payments would soon rise beyond what many could afford. Blink 4. Steve Eisman came to believe the industry was built on deception. Steve Eisman reached the housing trade through a different path. He was loud, confrontational, and willing to tell company executives that their businesses made no sense. Early in his career, he studied financial companies that lent money to people with weak credit. The more he learned, the less he trusted the industry. Subprime lenders described themselves as businesses expanding access to credit. Eisman saw something darker. Many borrowers did not understand the full cost of their loans. Mortgage companies earned money by producing volume, not by ensuring that homeowners could repay. Wall Street then turned the loans into products and passed them to investors. When companies failed, executives could blame economic conditions. Borrowers lost their homes, employees lost their jobs, and investors absorbed losses. But the people who created the loans had already collected their fees. Eisman and his team at Front Point Partners became interested in the possibility of betting against subprime mortgage bonds. Their opportunity arrived through Greg Lippmann, a Deutsche Bank trader who understood that the mortgage market had become unstable. Lippmann was not motivated by moral outrage. He saw a profitable trade. He explained that investors could use credit default swaps to bet against subprime bonds. Eisman's team investigated the loans and concluded that the situation was even worse than Lippmann suggested. They began building their short position. The strangest part was that the industry continued behaving as if nothing was wrong. Mortgage companies reported profits. Banks created more securities. Rating agencies continued approving them. Investors continued buying. Eisman's team attended industry events and spoke with the people managing CDOs. Instead of finding hidden expertise, they often found people who did not appear to understand the risk inside their own products. The system was not protected by people who had studied the danger and concluded that it was manageable. It was protected by confidence, incentives, and the assumption that the recent past would continue forever. Blink 5. Cornwall Capital discovered that the market was underpricing disaster. Charlie Ledley and Jamie Mai did not begin with the experience or resources of a major Wall Street fund. They formed Cornwall Capital with a relatively small amount of money and searched for unusual investments where the possible gain was far larger than the possible loss. Their strategy focused on events that the market considered unlikely. Most of their ideas failed or produced little. But when the market seriously underestimated a possibility, one successful trade could compensate for many small losses. They were not trying to predict ordinary outcomes. They were searching for mispriced uncertainty. With help from the more experienced Ben Hockett, they learned about the subprime mortgage trade. At first, the system was difficult to understand. The bond market had its own language, and major banks were not designed to serve a small investment firm. But Ledley and Mai kept investigating. They eventually realized that the crisis could spread far beyond the lowest-rated mortgage bonds. Many investors understood that the weakest tranches might fail. The cost of betting against them had therefore become more expensive. But the supposedly safer mortgage securities remained cheap to short because almost everyone trusted their high ratings. Cornwall believed those ratings were misleading. If housing losses became severe, the damage would travel upward through the structure. Securities considered nearly impossible to lose money could collapse. This created the type of trade Cornwall preferred. The cost of the bet was limited. The potential payout was enormous. Their small size became an advantage. Large institutions were often trapped by existing positions, internal politics, and fear of challenging accepted wisdom. Cornwall had fewer assumptions to defend. Ledley and Mai could ask basic questions that experienced professionals had stopped asking. What if the ratings were wrong? What if the models were wrong? What if the people selling these products did not understand them? The outsiders could see the problem partly because they had not spent years learning to treat the system as normal. Blink 6. The financial system multiplied the same risk again and again. The housing market contained a limited number of actual mortgages, but Wall Street created financial bets that allowed the losses connected to those mortgages to become much larger than the original loans. This happened through synthetic CDOs. A normal mortgage bond was connected to real payments from homeowners. A synthetic product did not need to contain new mortgages. It could be created from credit default swaps, referencing mortgage bonds that already existed. This meant multiple investors could make opposing bets on the same group of loans. One investor bet that the bonds would continue paying. Another bet that they would fail. Wall Street stood between them, creating the deal and collecting fees. The short sellers were not simply betting against existing mortgage investments. Their demand sometimes helped Wall Street create additional products for investors who wanted exposure to mortgage risk. The system was effectively manufacturing new ways to lose money from the same weak loans. This also made the financial institutions dangerously connected. A hedge fund might purchase protection from a bank. The bank might transfer some risk to another institution. Insurance giant AIG sold protection on enormous amounts of mortgage-related securities. Each participant assumed that another party would be able to pay. But if mortgage bonds collapsed everywhere at once, the losses would travel across the network. The system could not easily identify who ultimately held the risk. Even major banks did not always understand their own exposure. Individual trading desks earned bonuses by generating short-term profits, while the possibility of future losses belonged to the larger institution. This was one of the deepest problems revealed by the book. A crisis did not require everyone to be foolish in exactly the same way. Each person only needed to follow the incentives directly in front of them. The mortgage broker needed to create another loan. The investment banker needed to package another bond. The rating agency needed to keep the banks as paying customers. The CDO manager needed more assets. The executive needed another profitable quarter. Each decision could appear locally rational while making the overall system more dangerous. Blink 7. Seeing the truth early can feel exactly like being wrong. Barry began paying premiums on his credit default swaps before the mortgage bonds collapsed. Month after month, money left his fund. His investors saw the cost but not the future payoff. Many had trusted him to select undervalued stocks, not to make a massive bet against housing. They became angry. Some demanded their money back. Others accused him of changing his strategy or taking an unnecessary risk. Barry faced a terrible form of pressure. He believed his analysis was correct, yet the visible evidence appeared to favor his critics. Home prices had not completely collapsed. The bonds were still receiving high ratings. Banks continued reporting prices that suggested the securities remained valuable. Even when mortgage defaults began rising, the market prices of some bonds did not immediately reflect the deterioration. The institutions that had sold protection had little reason to mark the contracts in Barry's favor before they were forced to do so. Eisman's team and Cornwall faced similar uncertainty. They could see that borrowers were failing, yet the financial products built from those loans remained strangely stable. The separation between reality and price could not continue forever, but it could continue longer than expected. This reveals one of the hardest lessons in investing. Being early and being wrong can look identical for a long time. A correct idea is not enough. The investor must survive until the market recognizes it. That requires capital, patience, and the ability to tolerate doubt. But conviction can also become dangerous. People who are wrong frequently describe themselves as early. The difference lies in the quality of the evidence. Barry did not maintain his position because of a feeling. He had studied the underlying loans, identified when rates would reset, and watched defaults begin to increase. His confidence came from detailed analysis. The market could delay the result. It could not permanently make bad borrowers capable of repaying unaffordable loans. Blink 8. When the system finally broke, winning did not feel like victory. The housing market weakened. Borrowers began missing payments in greater numbers. Mortgage lenders failed. The lowest-rated bonds collapsed, followed by securities that had been presented as much safer. The crisis spread into the institutions that had created, sold, and insured the products. Bear Stearns disappeared. Lehman Brothers failed. AIG could not meet its obligations without government support. Confidence across the financial system collapsed. The short positions held by Barry Eisman and Cornwall became extraordinarily valuable, but receiving the money was not always simple. Their profits depended on large financial institutions remaining capable of paying them. If the entire banking system collapsed, a winning contract with a failed counterparty might become worthless. They had correctly predicted a disaster that now threatened the mechanism through which they expected to collect. Eventually, the trades generated enormous profits. Barry's investors, many of whom had doubted and criticized him, received extraordinary returns. Eisman's team made a fortune. Cornwall transformed from a tiny operation into a highly successful investment firm. Yet the ending was not presented as a celebration. Their winnings came from an event that damaged millions of lives. Families lost homes, workers lost jobs, retirement accounts fell in value. Governments used public resources to stabilize financial institutions. Many of the executives who had helped create the disaster kept the wealth they had earned during the boom. The people who saw the crisis coming were rewarded because they had been correct. The institutions that failed were often rescued because allowing them to collapse completely would have caused even greater damage. Ordinary citizens suffered despite never understanding the complicated securities that had brought the system down. This gave the story an uncomfortable conclusion. The short sellers had won the trade, but almost everyone was living inside the economy that lost. Blink 9. The real failure was not a lack of intelligence. The financial crisis was created by some of the most educated and highly paid people in the economy. The banks employed talented traders, mathematicians, and risk managers. Rating agencies used sophisticated models. Investors had access to enormous amounts of information. The system did not collapse because no one was intelligent enough to understand finance. It collapsed because intelligence was placed inside a structure with terrible incentives. Mortgage lenders were rewarded for creating loans, not for ensuring they would be repaid. Banks were rewarded for packaging and selling securities, not for protecting the final buyer. Rating agencies were paid by the institutions requesting the ratings. Executives earned bonuses from short-term revenue, while the largest risks might not become visible for years. Complexity made responsibility easier to avoid. When something went wrong, each participant could point towards someone else. The lender blamed the borrower. The bank blamed the rating agency. The rating agency blamed its models. The investor claimed to have trusted the bank. Yet the warning signs were visible to anyone willing to examine the underlying loans. The central characters of The Big Short were not magical forecasters. They did not predict every detail of the crisis or understand every consequence. Their advantage was that they looked closely at the part of the system everyone else had chosen to ignore. Burry read the mortgage documents. Eisman studied the businesses making the loans. Cornwall questioned whether the safest-looking securities were truly safe. They were outsiders in different ways, and that distance helped them recognize how irrational the accepted system had become. The book is therefore not only a story about making money from a market collapse. It is a warning about what happens when people stop asking basic questions because an idea has become widely accepted. A rising market is not proof that the market is healthy. A high credit rating is not proof that an investment is safe. A complicated model is not proof that risk has disappeared. And a successful institution is not necessarily managed by people who understand the danger it has created. Sometimes the people inside a system know more facts than anyone else, but understand the system less clearly because their careers, income, and identities depend on believing that it works. The outsiders saw the crisis because they were willing to imagine that the experts could be wrong. That was The Big Short. But the deeper story was the enormous long position taken by nearly the entire financial world on a single assumption. Housing prices would continue rising. Once that assumption failed, everything built on top of it began falling apart. Key takeaways from the book. The Big Short explains how weak home loans were packaged into mortgage bonds, reorganized into CDOs, and sold as safe investments. The system grew because lenders, banks, rating agencies, and investors were all rewarded while housing prices continued rising. Michael Burry, Steve Eisman, and Cornwall Capital independently discovered that the underlying loans were far weaker than the ratings suggested. They used credit default swaps to bet against mortgage securities and eventually earned enormous profits when the housing market collapsed. The book's central lesson is that intelligence and complexity cannot protect a system with bad incentives. The investors who saw the crisis coming succeeded because they examined the underlying reality, questioned accepted beliefs, and remained committed even when being early made them appear wrong.